Welcome to The Week in Review, brought to you by Inverse. Investing makes sense when you learn by doing. Here's a review of the major market-related events this past week. Our top story, of course, is the Oscars, and how Timothée Chalamet was completely snubbed, all because he doesn't like ballet. No, wait, the Oscars has absolutely no bearing on anything important in the world. Sorry, folks, let's start again. The Bank of Canada kept its key interest rate unchanged at 2.25%, marking its third consecutive hold. The hold comes despite Canada's annual inflation rate falling to 1.8% in February 2026, down from 2.3% in January and below market expectations. The tone was cautious and heavily shaped by the war in the Middle East and the resulting spike in oil prices. This was not a steady-as-she-goes hold. It was a risk management hold. The bank was signaling, we're watching oil, we're watching inflation, we're not committing to anything. Let's continue to see other people. The Federal Reserve kept its policy rate unchanged at 3.50% to 3.75%, also for the second straight meeting. Markets expected this, but the commentary was the real story. As officials said, they expect the war in the Middle East to worsen inflation this year, even if growth remains steady. Markets were volatile following both announcements as they were hoping for clarity, but instead got uncertainty layered on uncertainty. Problem solving instead of deep listening, breaking eye contact, and the large arm gestures didn't help either. The Producer Price Index tracks how much companies are paying to produce goods and services. It's basically the upstream version of inflation. If producer costs jump, consumer prices often follow. February's numbers came in unexpectedly hot. 0.7% monthly increase, far exceeding the 0.3% to 0.4% expected. It was a combination of surging services costs and a rebound in goods prices. Many of the current administration's policies are inflationary, and February's print underlined this. Without a change in policy, it is this analyst's opinion that we can expect inflation to be persistent. I'm reminded of the saying, doing the same stupid thing again and again and expecting not stupid results is the definition of stupidity. It was a very light week for earnings, with only 26 companies over $1 billion in market cap reporting. The group posted a 38% year-over-year increase in quarterly earnings, a return to positive growth after 2 weeks of decline. One of the biggest players in the transportation sector, FedEx, reported a rise in earnings of 19% year-over, making it arguably the most influential report of the week, given its role as a bellwether for global shipping volumes and business activity. Consumer Services had only one report this week, as Carnival shifted its earnings date to the 27th because someone's dog ate the financials. The lone reporter, Darden Restaurants, posted a 5% year-over-year increase, a steady result in a sector still navigating higher input costs and uneven consumer spending. At Inverse, we've been increasingly concerned that U.S. policy choices are creating conditions that are difficult for a healthy, stable economy. The escalation of the conflict in Iran has amplified those pressures. Unless there is a meaningful shift in tariffs, trade policy, relationships with key allies, and the energy shock triggered by the war, our outlook has turned decisively negative. From our perspective, this week's data is not an anomaly. It's the early stage of a broader trend. Well, that's it for the Week in Review. And remember, folks, this was the first Oscars where the voters were required to actually watch the nominated films. Now I know why The Martian was listed as a comedy. And was Cats really that bad? Thank goodness it was an isolated case of uninformed voting based on personal biases. If this behavior was more widespread, you could end up with some pretty disastrous... No, never mind.